Welcome to the deep dive. Today we are looking at, well, one of the most compelling stories on the NASDAQ right now. It's a perfect illustration, really, of that clash between a hot market narrative and cold financial reality.
Hmm.
We are diving deep into American Bitcoin Corp, ticker ABTC. This is a stock that's just exploded 83% on its debut. On the surface, it suggests massive success, right? Fueled by celebrity, by hype.
But, and this is a huge but, if you actually look under the hood, the balance sheet shows severe financial distress. I mean, the company is technically insolvent.
Wow.
So yeah, we're digging into sources dated September 19, 2025 to really dissect this incredible discrepancy. Our mission today is finding that gap between what the market thinks this is worth and what the company actually owns and earns.
And okay, here's the core takeaway you need to know right up front. The current share price, around $7.48, suggests this huge multi-billion-dollar enterprise.
Right.
But our fundamental analysis, even using pretty generous growth projections, places the intrinsic value somewhere in the low single digits per share.
That's a massive difference.
Huge. That massive premium, that, let's say, $7 gap per share, it seems to be entirely based on speculation and narrative. So we really need to unpack how the market is justifying this.
Let's do it.
Okay, let's start by defining what this company is actually trying to be, laying the groundwork.
Absolutely. This is Chapter 1, Business Understanding. So ABTC's core strategy is, well, pretty singular. They call themselves a Bitcoin accumulation platform.
Okay.
And their mandate, their only mandate really, is to maximize Bitcoin per share. They do this using a dual model, self-mining Bitcoin with their own machines, the ASICs, and also opportunistic open market purchases of Bitcoin.
Now, what's really interesting to me here is their operational choice, this asset-light model. They seem to be avoiding massive capital spending. Can you walk us through how that actually works?
Yeah, it's key to their story. They manage this through an exclusive service agreement with their majority owner, which is Hut 8 Corp. Hut 8 provides all the essential stuff: colocation, hosting, operational management.
Colocation meaning?
Basically, Hut 8 provides the physical buildings, the massive power connections needed, the industrial cooling.
Yeah.
Everything required to run thousands of these really energy-hungry mining machines.
Right.
So theoretically, this maximizes ABTC's capital efficiency. It lets them focus just on owning the mining rigs and the Bitcoin itself, not the expensive real estate and infrastructure build-out.
That sounds smart on one level, but wait. If Hut 8 controls all the critical infrastructure and holds the majority ownership stake, isn't ABTC just kind of a glorified holding company? Doesn't that seriously limit their independence, their ability to maybe innovate outside that specific relationship?
It absolutely does. That's a major point. And it ties into the governance concerns we'll definitely touch on later.
Yeah. Now, regarding scale, ABTC is a new entity, just formed after the merger with Griffin Digital Mining.
Right, the Griffin merger.
But they did enter the market with some size already. They recently expanded their hash rate, that's the measure of their total mining compute power, by 2.4 times. They're now at about 24 exahash per second, or EHs. Okay, 24 EHs. But hang on, scale and hashing power doesn't automatically mean they have a huge pile of Bitcoin, does it?
Precisely. That's the key distinction. Their actual treasury holds only 2,443 BTC.
Only 2,443.
Yeah, and to put that into context against their massive market cap and ambitions, you look at peers like MicroStrategy. They hold over 638,000 BTC.
Whoa.
Or Marathon Digital, another big miner, they're over 52,000 BTC. So ABTC is actually quite small in terms of the core asset they claim to be accumulating, despite this multi-billion-dollar valuation the market's giving them.
And we really can't talk about Bitcoin mining without hitting on the constant existential pressures in this industry. The competition is just fierce. You've got Mara, Riot, CLSK, all growing like crazy.
And then there's the halving. Every 4 years, like clockwork, the Bitcoin network cuts the block reward, the amount miners earn, clean in half. It forces these brutal efficiency gains just to stay afloat.
It's a tough neighborhood.
And if we zoom out even further, there's a potential long-term threat to the entire commercial mining sector. That's the possibility of sovereign nations getting into the game.
Like governments mining Bitcoin.
Exactly. Using massive state-owned power grids. They wouldn't have the same profit motive as commercial miners, which could drive mining difficulty, how hard it is to find a block absolutely sky high. That could squeeze commercial margins down to almost nothing eventually.
Okay, so given all those intense headwinds, what is ABTC's competitive advantage? What is it that allows them, or seems to allow them, to command this absolutely insane valuation premium we're seeing?
Well, ABTC's most distinct advantage, and certainly its most contentious one, is brand recognition.
Your Trump
The
connection.
direct involvement of Eric Trump, his co-founder and chief strategy officer, that provides absolutely unparalleled media coverage and potentially capital-raising ability. That celebrity brand is a unique asset, no doubt, for attracting attention and maybe investment dollars. But it is absolutely a double-edged sword. It guarantees intense political and regulatory scrutiny right along with the headlines.
Okay, so if the business model really hinges on that Hut 8 partnership and the asset-light structure, let's look at the people actually steering the ship. This takes us to Chapter 2, Management Evaluation.
Right. The leadership team seems like a deliberate blend. You have Asher Canute as executive chairman. He's also the CEO of Hut 8, the majority owner. So he brings the operational scaling expertise, and he notably navigated Hut 8 through that really brutal 2022 crypto winter.
Okay, operational chops.
And then you have Eric Trump as chief strategy officer. He brings the brand focus, the media access, and his background from the Trump organization, primarily in real estate.
But this kind of high-profile leadership, it comes with significant baggage, doesn't it, based on the sources?
It does. The sources we reviewed clearly highlight the material reputational risk that stems from Eric Trump's business history. This includes past investigations, ethical controversies around financial practices, even a charitable foundation issue. And that history inevitably invites heightened regulatory scrutiny and raises governance concerns. Investors really have to factor that into the overall risk profile here. It's not trivial.
And sticking with risks, on the data side specifically, we have to mention this massive red flag we saw almost immediately after the merger completed. There's just severe inconsistency in basic financial data, like even the market capitalization reported across reputable platforms. What does that signal to you?
Yeah, that's deeply concerning. It signals a genuinely chaotic information environment. It makes basic due diligence incredibly difficult when you can't even rely on fundamental numbers like market cap. It suggests maybe operational confusion or integration issues following the merger. Capital allocation strategy, though, that seems pretty clear. They're putting everything into buying more ASICs, the mining machines, and making open market Bitcoin purchases. That's it.
So no profits means no returns to shareholders right now.
Correct. They are unprofitable, and they're definitely not returning capital through buybacks or dividends. They were strictly in a capital consumption phase, burning cash to grow.
Okay, now we have to pause on one truly shocking financial claim we found. The company reported a return on invested capital, an ROIC, of 146.49%. Wait a minute. How is that even mathematically possible when the company is losing money hand over fist?
It's not possible.
Yeah.
Simple as that. That ROIC figure is mathematically inconsistent with their financials and frankly must be entirely disregarded.
Just thrown out.
Completely.
Yeah.
When a company has deeply negative profitability metrics like this, any reported high ROIC is a major red flag. It signals either a significant data error, maybe a misapplication of the formula, or potentially an attempt to manipulate metrics. At best, it's an indicator of very poor data quality.
Okay. So with profitability metrics that are just disastrously negative, you have to ask again, how on earth does the market justify a price tag this high? And that brings us squarely to Chapter 3, Financial Analysis. This is where that glowing narrative just smashes head-on into cold, hard reality.
Yep, let's get into the numbers. First, the market's perception of value. NASDAQ currently reports a market capitalization of $6.46 billion.
Billion, with a B.
Billion, with a B. But crucially, you have to remember those data discrepancies we mentioned. Some reputable sources show figures as low as $124 million. That's a huge range. But let's work with the figure the current trading price supports. $6.46 billion.
Okay. Now, profitability. This is where it gets, well, almost unbelievable. Second quarter 2025 revenue was only $1.38 million.
Tiny.
And that's a 75% decline year over year, so shrinking revenue. And the net profit margin, prepare yourself, it was a staggering negative 381.77%.
Wow. Let me just repeat that. Negative 381%. That means for every single dollar of revenue the company generated in Q2, they incurred nearly $4 in net losses.
Losing $4 for every dollar they bring in.
Yes. The financial distress is severe. And if you look at the balance sheet, it confirms this picture. Total assets stand at $6.20 million. Total liabilities are $17.19 million.
Which means?
It means they have negative total equity of negative $10.99 million. Literally, they owe more than everything they own combined. By accounting definition, they are technically insolvent.
Insolvent. Okay.
And liquidity, also extremely precarious. They reported only about $750,000 in cash. That's against $17.19 million in total liabilities. Not a lot of runway there.
So let's recap this madness. We have a $6.46 billion market valuation, backed by a company that is technically insolvent, shrinking rapidly, and burning cash at an alarming rate.
Correct.
Since price to earnings, PE is meaningless here because there are no earnings, only losses. We have to look at price to sales, or PS. Based on that $6.46 billion market cap and their tiny annualized revenue, the PS ratio comes out to an astronomical approximately 1,170 times.
1,170 times sales. Just let that sink in. Put that into perspective for you, the listener. Established, profitable peers in this exact same Bitcoin mining sector, like Marathon Digital, currently trade around maybe 5.6 times price to sales.
5.6 versus 1,170.
Exactly. A PS ratio of 1,170 suggests the market expects this tiny, insolvent, shrinking company to somehow grow maybe 1,000 times bigger almost overnight. It's like valuing a brand new corner lemonade stand as if it were already Coca-Cola, based purely on the fact that, I don't know, a celebrity walked by it once.
Right. That mathematical chasm is really what we're here to explore. Our own educational intrinsic valuation using a standard discounted cash flow model. And we had to use extremely aggressive assumptions, like over 100% initial revenue growth for several years, plus a very high discount rate around 25% because of the extreme risks, like that beta of over 4 we found.
Even with all that.
Yeah. Even bending over backwards to be optimistic, the model yields an intrinsic value somewhere in the low single digits per share. The current $7.48 price is just completely, utterly disconnected from any fundamental reality we can model.
The narrative is doing all the work here.
Entirely. Okay, let's shift perspective now. Let's move on to the external view with Chapter 4, Markets Sentiment. What are the professional analysts saying about this valuation? Surely someone is calling this out.
Well, you'd think so, but professional analyst coverage is virtually non-existent. Only one firm, H.C. Wainwright, initiated coverage recently. They gave it a neutral rating.
Okay, neutral.
But they assigned a price target of $0.
$0.
$0.
Yeah.
They essentially threw up their hands and said they couldn't provide a meaningful valuation due to the extreme uncertainty, the data opacity, the whole chaotic situation.
Wow. So no help from the sell-side analysts. What about the media narrative?
The media narrative seems focused purely on the spectacle. You know, the massive volatility, the fact it was halted 7 times on its first trading day, and of course the Trump connection. That kind of coverage tends to attract pure speculators, momentum chasers, not really long-term fundamental investors looking at the business itself.
And we can actually see this deep division in the market, this battle between hype and fundamentals reflected in the short interest data, can't we?
Absolutely. Short interest is exceptionally high. The source is reported as 28.87% of the float. That's a huge percentage of the tradable shares being bet against the company. It indicates a really powerful conviction among bearish traders that this stock is drastically fundamentally overvalued.
And making that bet isn't cheap.
Not at all. That conviction is very costly. The cost to borrow shares to short them is reported as extremely high, over 270% annual interest, just to borrow the stock. Exactly. That shows how desperate the short sellers are to maintain their positions against this name. They're willing to pay almost triple the stock's price per year, just in borrowing fees, effectively. It demonstrates an extreme conviction that this stock will eventually collapse, and they'll still profit, despite that enormous carrying cost.
That's a strong signal from the shorts. Now, let's look at who actually owns the company. Chapter 5. Ownership structure gives us crucial insight into control and, maybe more importantly, confidence from those closest to the company.
Yeah, the ownership picture is very concentrated. As we mentioned, Hut 8 Corp holds the controlling stake, 64.5%.
The majority owner providing the services.
Exactly. And the concentration goes further. The top 6 shareholders combine control over 72% of the entire company. This effectively gives minority shareholders, the public float, virtually zero influence over strategic direction or governance. It concentrates risk very heavily among just a few key parties.
And this concentration leads us to what might be the ultimate insider verdict on the valuation. We absolutely must highlight this profoundly bearish insider transaction that happened. On the very first day the stock traded publicly, September 3rd, 2025, entities linked to one of the company directors executed sales of 2.53 million shares. They generated $20.1 million in cash proceeds. Immediately.
Wow. Day one selling. $20 million. That is an incredibly powerful signal. When the people who are closest to the company, the ones who presumably know the true state of the business, the real valuation, the actual risk profile, when they are aggressively selling millions of dollars worth of stock immediately upon listing,
Yeah.
it sends an overwhelmingly negative signal about their personal belief
Yeah.
in the current share price. Actions speak louder than words.
Absolutely. A $20 million action on day one speaks volumes. Okay, now let's try to wrap our arms around all these challenges and, well, any potential opportunities. This is Chapter 6, Risk Assessment. Let's synthesize this whole kind of crazy picture.
Okay, a quick SWOT analysis might help structure this. Key strengths. You've got the asset-light model leveraging Hut 8's infrastructure. That's definitely a plus for capital efficiency. You have the unparalleled brand recognition from the Trump connection, which clearly helps attract attention. And they have a singular focus on Bitcoin accumulation, which is clear.
Okay, weaknesses.
The key weaknesses are, frankly, catastrophic. You have the financial insolvency, the negative equity. There's a total lack of operating history as this new merged entity. There's high governance risk due to that super concentrated ownership and the leadership's reputational baggage we discussed. And then there's just the data chaos making analysis difficult.
Right, and the external threats.
The key threats are intense and industry-wide. You've got the inherent volatility of Bitcoin itself, fierce competition from established, better capitalized miners, that relentless margin compression from future halvings, plus that long-term potential threat of sovereign mining disrupting the whole commercial space.
And on top of those industry threats, we have big macroeconomic risks looming too, right? High interest rates make the cost of any capital they might need for growth much more expensive.
Critical for a cash-burning company.
Exactly. And then geopolitical factors, things like potential new U.S. tariffs on imported ASIC mining machines, which mostly come from Asia, that could substantially increase their primary capital costs, hitting their model directly. And remember, we noted earlier that the stock's beta is 4.02.
Yeah, 4 times market sensitivity.
Meaning it's 4 times more volatile, more sensitive to broad market movements than the average stock. That number basically reflects all these risks wrapped up together.
Looking at this whole picture, this stock leaves absolutely zero margin of safety for an investor at the current price. None.
Okay, let's bring it all home. Chapter 7, conclusion. Let's synthesize the bull case versus the bear case one last time for the listener, crystallizing the core conflict here.
All right. The bull case. It's almost pure narrative, really. It rests on getting pure play exposure to Bitcoin price appreciation. It assumes rapid scaling is possible through that asset-light Hut 8 partnership. And critically, it relies on the Trump brand's unique ability to attract massive amounts of capital for aggressive growth.
All of which needs to happen if, and it's a big if, we get a substantial immediate bull market in Bitcoin itself to lift all boats.
Exactly. It's a chain of very optimistic assumptions.
Okay, now the bear case.
The bear case is grounded firmly in the fundamentals, and it's overwhelming. You start with the financial insolvency negative equity. You have that absolutely astronomical price-to-sales ratio of around 11,170x.
Yeah.
You have profound governance and reputational risks tied to ownership and leadership.
Yeah.
And you have that crystal clear lack of confidence signaled by the $20 million insider sale on day one.
Plus the industry context.
Plus the fact that the underlying business operates in a brutal, commoditized industry facing inescapable pressure from halvings and potentially sovereign competition down the line.
So our final verdict seems pretty clear-cut based on the data.
It does. At its current share price, around $7.88, ABTC appears substantially overvalued based on, well, any conventional financial metric you can apply. And investment here isn't really based on cash flow potential or underlying equity value. It's a high-risk speculation, pure and simple. It's a bet on the continuation of hype, a bet on the brand's ability to keep raising capital before the underlying business runs out of cash completely.
So the company's truly unique assets seem to be its access to Hut 8's infrastructure and its celebrity brand power. But its fundamental weakness is a severe, demonstrated inability to actually generate profit, which, for you, the learner, raises this really important question that kind of defines this strange market moment we're in. In a highly commoditized industry like Bitcoin mining, does branding and celebrity hype actually matter more to the stock price than the underlying balance sheet fundamentals?
It's a fascinating question. And just a reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research before making any investment decisions.
Well said. And if you found this deep dive useful, please do like and subscribe to Stock Analytics AI. Remember, for just $4.99 per month, members get priority deep dives on individual tickers. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to all that research as it drops.
That's a lot of analysis.
It is. And if you just want a one-off deep dive on any specific ticker that interests you, just drop us a super thanks on the video and we'll add it to our queue. Thanks for joining us on the deep dive.